The United Kingdom is in a crisis. The only reason that the economy hasn't collapsed yet is because the government has been relying on debt more than ever. But you can't borrow your way out of a crisis. A debt is a debt, and it must be paid back. But that's not even the biggest problem. After all of that debt and all of that spending by the government, the economy seems in a much worse shape than it was prior to that. And it seems like the British economy is about to face a stagflation. A stagflation is an economic nightmare. If it happens, everybody is going to be wiped out. Because a stagflation is a rising inflation, a rising unemployment, and at the same time, lower economic growth, which means that prices are going to keep rising, but your wages are going to keep going down, which is essentially going to make everybody much poorer. So let's figure out how close the British economy is to a stagflation. If you're ready, give this video a thumbs up and let's dive right into it. Just by looking at the British GDP, you already can see a very clear problem. Over the last 25 years, it seems like the economy hasn't been growing at all. In 2007, the GDP was $3.1 trillion. Today, it's $3.3 trillion. That increase isn't really much, given the fact that almost 18 years has passed. What have you been doing? Let me ask you a different question. Did prices increase over the last 18 years? Of course they did. But did the economy grow over the last 18 years? It did not. Which means that prices have grown on one side, but people's wages haven't grown on the other side. Because if wages have grown on the other side, then the economy would have grown as well. But that did not happen, which means that over the last 18 years, every single British has been getting poorer and poorer. And the only real growth that you see in this graph is in 2020. And it happened because the government massively borrowed money to get the economy out of the pandemic. Even if you look at the recent GDP growth, you see the exact same pattern, that there is a negative GDP growth. In May, it was negative 0.1%. In April, it was negative 0.3%. And the only reason that it has grown in February and March is because the Bank of England cut the interest rates. If it wasn't for the cut of interest rates by the Bank of England, then the GDP wouldn't have grown at all. In fact, if you look over the last 12 months, there has been multiple months where the GDP had a negative growth. And if we are going to have 2 consecutive negative GDP growth, that's already a recession. And if the Bank of England wouldn't lower down the interest rates, let's say to 1% or 2%, then chances of a recession is very likely. And if that recession is going to continue for multiple years, then you are going to face a depression. But let's be a bit optimistic. Let's look at the inflation, because at the end of the day, stagflation isn't just about the economic growth. You have to take a look at the second aspect of stagflation, which is inflation. Now, inflation peaked back in 2023 at around 10 or 11%. However, since then, the Bank of England has done a fantastic job by hiking the rates from almost 0.5% to as high as 5.5%. And that had its impact where the inflation was lowered down to almost 2% by May of 2023. But a 2% inflation rate for a single month is not enough. If you want to bring down inflation to 2%, you need at least 12 months of 2% inflation rate for you to claim that we had a 2% inflation. That's why if you look at the numbers, inflation has been rising since then. And currently, it's almost like 4%. And this is how they calculate inflation. There are different ways to calculate inflation. Like you can literally selectively take a basket of stuff and you can say that this is the inflation. However, that does not apply to the real life of people. Because, for example, when you take things such as CPI does not include within itself house prices. Suddenly, house prices have grown by 30%, but you don't see that growth in the CPI report, which means that inflation hasn't grown that much. Even by those standards, inflation has grown by 3.5%. And here is the biggest problem, is that the Bank of England cutting interest rates already by a single percentage, and it seems like they will continue cutting interest rates. Now, let me ask you a question. Your inflation is 3.4%. Even according to the Bank of England itself, like the inflation currently is 3.4% and the targeted inflation is 2%, and you're lowering down interest rates. What does lowering down interest rates does to the economy? it increases inflation because it's going to increase the supply of money in the economy. So you haven't fixed inflation yet, and you are already lowering down interest rates. Now compare that to the Federal Reserve. The economy in the US isn't facing a recession, at least in the foreseeable future, but at the same time, the inflation has gone down to like 2.3%. And even in that case, the Federal Reserve is very hesitant to lower down inflation because it knows that you need at least 12 months of consistent inflation of 2% or below that in order for you to claim that. That means that inflation is not going to go below 3.4%. In fact, it is only going to rise after that. But it also could mean that the government is very desperate, and because they want to avoid a recession, since I've showed you just prior to that the GDP is slowing down, and if you don't want to see a recession, you lower down the interest rates in order to give the economy that boost. However, that boost is only going to be in numbers. It's not going to be in real life. In real life, people will simply see the value of their savings to be devalued. The third part of the stagflation is the unemployment rate. Unemployment has been rising consistently over the last year or so. It reached its all-time low back in July of 2022. However, since then, the trend is very clear. It's about to hit 4.7%. Now, 4.7% isn't really that bad. If you have it like 5% and above that, then it's a problem, but the trend is very clear. It's a matter of time before it's going to get to 5%, especially when you see a lower economic activity. That's the first problem. Secondly, you see that the government is so desperate to lower down interest rates when inflation is like 3.4%, which means that based on their math, it seems like the unemployment is about to hit 5%, and after that, it can literally keep growing. The second problem is that when you have high inflation, businesses are very cautious about spending. Because high inflation means that the cost of doing business is rising. And when you don't control your cost, then you're not have profitable business. Because at the end of the day, business is about getting something, turning into something else, and then making a profit by putting your margin on the top of it. But when prices are rising so fast, you try to cut costs in order to control the cost of doing the business. And one of the first things that you would do is cut your number of employees, because payroll is the largest expense that any business would possibly have. And when you're cutting employment, that means that unemployment starts rising, and this graph will keep trending upwards. The second graph I want you to look at is the Consumer Confidence Index. You see, the economy is like a self-fulfilling prophecy. People are going to act based on what they believe will happen with the economy. So for example, if everybody believes that the economy is going to continue to grow, everybody will start spending. If everybody believes that the stock market will continue to grow, people start buying stocks because they want to make a profit out of it. And vice versa. If people believe that the stock market will continue crashing, people will start selling their stocks, which is why it's very important to create an environment where people believe in the economy, where people want to spend their money. But looking at the Consumer Confidence Index, it seems like people have very little faith in the economy and it's going negative. And that means that people do not believe that the economy is going to get better. People do not believe that the economy is going to keep growing. In fact, people believe that the economy is only going to get worse, wages will stagnate, and inflation is going to keep rising, which means that people, when they make money, they are more likely to save it or keep it in some kind of a savings account instead of spending that money because they're worried about their future. So if a stagflation is an economic slowdown, rising inflation and rising unemployment, then we see the exact three factors happening with the British economy, which means that the British economy is one step closer to a stagflation. And before you know it, it actually could get a lot worse than it's right now. But this is not the first time that the British economy has faced a stagflation. In fact, multiple countries have faced similar problems in the past, and somehow they solved the problem. What makes this stagflation very different from all other stagflations is by looking at the deficit of the government. The British government's deficit isn't actually that bad. It's around like 10 to 15% of the entire budget, which is not bad if you compare that to the United States. However, the problem is when you look at the deficit historically and suddenly realize that over the last 25 years, the government has been running a huge deficit. It wasn't that huge every single time. It was really huge back during the 2008 financial crisis and the 2020 crisis. And that deficit has been accumulating to the point where the current debt to GDP ratio is around 100%. When you have so much debt, and when the amount of your debt is equal to the size of your economy, you have to make interest payments on your debt. Remember what I told you in the beginning of this video. A debt is a debt and it must be paid back. And nobody is going to give you money for free. Every debt has a price, and the price is the interest rates that you pay on that debt. Currently, the British government has to pay over £100 billion annually to sustain the current debt. And this is the biggest problem that is worsening the stagflation that the government is facing. These interest payments are forcing the government to keep running a deficit. It's impossible for now for the government to continue or to stop running a deficit because they have all of these social programs that they must run. There is no way to stop them because people have been paying taxes in order to have healthcare. People have been paying taxes to have a pension, and now suddenly you want to tell them, listen, no longer healthcare and no longer a pension. You cannot do that. That is literally robbery, especially for the people who've been paying those taxes for decades. On the other side, you have the people from whom you borrowed the money. You cannot also tell them that you're not going to pay your debts. That will force you to default on your currency and nobody going to trust you again, which means that you are going to destroy your credit score. So you have this situation where you cannot cut spending on either sides, which means that you are going to keep borrowing money, which is going to increase the supply of money in the economy. So if you don't have the money and you're forced to make these payments, you're going to go to the bond market and borrow more money from investors. When you borrow more money from investors, especially when there are not enough investors to pay you, then you're going to borrow that money from the central bank. And in this case, the Bank of England, you're going to increase the money supply. And that increase in the money supply is going to keep creating inflation. And one of the fundamental reasons why you have a stagflation is because inflation continues rising and your economy isn't growing. Growing the economy is not as easy as growing inflation. You can grow inflation by simply increasing the money supply. But in order to grow the economy, you have to become more productive. You have to produce more things. You have to be much more efficient. These are difficult things to do. Printing money is an easy thing to do, which is why the government is more and more relying on the printing press and increasing inflation instead of actually growing the economy. That's why there is a huge chance that the British economy is going to turn into a stagflation. Stagflation is very dangerous because you know for a fact that we have inflation. So prices will increase. So you are going to go to the groceries. Next year, those prices are going to be higher. If you're paying rent, next year, prices of rent are going to rise. If you're taking an Uber, next year, prices on the Ubers are going to rise. However, you know what is not going to rise? Is your wage, is your fixed income, especially if you're working for the government or for a huge corporation and you have an average job. Maybe they will grow your income slightly, but not as much as inflation is going to grow, which means that from now onwards, until this problem is going to be fixed, you are going to get poorer and poorer year by year. The only proven way that I know historically that can somebody protect himself against inflation is to hold assets that are going to rise as long as inflation. Let me give you an example. You have your house. If you're a homeowner, you know that the price of your house has been growing for the last 20 years. Some years it hasn't been doing great. Other times, maybe house prices collapsed back in 2008. However, historically, over a long period of time, prices have been adjusted to inflation, which is why it's important, or the only way to protect yourself is to be invested in the right assets. Normally, I would say that it's better for you to go and invest in the stock market because stock market produces something, which means that even if you look at any indicator or whatsoever, you will find out that the stock market consistently grows much faster than house prices. However, if you look at the London Stock Exchange, you'll see something fascinating. Over the last 18 years, the FTSE 100 index has grown by 37%. Now, this is an index that tracks 100 most valuable companies in England. If the stock market has grown by 37%, but inflation is growing by over 100% over the exact same period. Do you think it's a good investment? And that's why it's very difficult to convince somebody to invest in the London stock market, which is why if you're getting into the markets, you always have to take a look at the US stock exchange. Over the exact same period, the stock market or the S&P 500, it's pretty similar to the same index of London Stock Exchange that tracks 100 most valuable companies. But in the US, we have like the top 500. And it makes sense because the US is a much larger economy compared to England, and the US is a much bigger country compared to the United Kingdom. But anyways, over the exact same period, it has grown by 335%. And that's why I honestly do not understand the people who invest in the British stock market, because it makes no sense whatsoever. But a lot of people are scared. They don't know how to get started. They don't have a proven strategy to at least invest in the right assets that would get them real good returns. And that's why if you're serious about investing and you're serious about protecting your wealth against this inflation, and most importantly against this stagflation, then make sure to check out the first link in the description of this video. Now, you don't have to buy anything there. You don't have to click on anything over there. You don't have to pay for anything over there. All you have to do is to check out and you will find out more about it. That's it for today, guys. Thanks for watching, and I will see you in the next one.